my day trading career over again if I had to start from scratch. And before getting to a point of developing an entire process and setting my trading up to be able to scale to $3,000, sometimes $5,000 single profit days, I realistically wasted years of my 20s with thousands of hours of being confused and also thousands of dollars that I didn't need to waste had I have known the information in the foundation that I'm going to share with you in this video. So I'm going to start with foundational information. So a simple way of looking at trading to start with the basics. Then I'm going to show you the websites and the tools that you're going to need to follow along with this process. I'm going to talk about trading psychology, which is probably the most important thing that will either make or break your trading. A simple way to understand trading math that can be really confusing in the beginning, as well as a complete crash course of the most important things that I know about technical analysis. Then I'm going to show you how to build and test your own strategies. Then at the end, I'm going to show you how we can take everything that we've learned, and we're going to apply them into a real life scenario to show you working them in real time. So by the time you make it through this entire video, you're going to have a clear-cut, simplified path to starting your trading career properly. Okay, so let's first start and set the foundation by understanding how trading works and how we should be looking at the market. Okay, there's a lot of technical elements that can be really confusing, and if you learn bits and pieces of it, it can throw you off the rails. This is a very simple way to understand how the market works and how the mechanics of it work. So over here, I have a chart open, but right now we're not going to worry about anything other than how and why the market is moving. Okay, so whenever we're looking at a chart, which in this case is this blue line, we're looking at increases and decreases. So all the chart is showing us is a visual representation of mass human psychology, meaning that there are buyers and there are sellers. Now, this is done with algorithms, it's done by physical trading, this is done in all sorts of different ways. So it's not as simple as people just clicking buy and sell, right? But the general premise is the market is adjusting to fill imbalances which are caused by supply and demand. So how this works is like this. Let's take right here, for example. In this part of the chart, when price is moving up, that means that there is demand from buyers and supply from sellers. If the demand outweighs the supply, the market is going to move up until there's another point where supply starts to outweigh the demand, and the market will correct until once again there's more demand than supply, and that will sort of bounce back and forth, which is going to produce something called volatility. Now, volatility is basically anytime there are drastic big moves in the market. And these are going to open up trading opportunities for us later. So simply put, as traders, our job is to find areas of the market where we can enter at a certain price, have the price increase to another price, then however many of these we bought times the increase is going to give us our profit. So if we bought 100 of these units at $200 and it increases to 205, that's $5 in profit per 100, which is going to give us $500 in profit. But let's take another layer deeper to start understanding where these intraday opportunities come from. So let's take a 1 year starting point as an example. Over the course of a year, this is the general stock market. We can see anywhere from 10, 15, 20, even 30% gains in an individual year. That means that if we were to buy $100 worth of SPX at this point and price increases, we now have $130, and technically our total risk implication is if everything were to melt down and technically go to zero, we're technically risking $100. This is the concept of investing. Now, you're only going to get, say, 10, 20, 30% in a good year, but usually right around 10%. So effectively, we'd have to wait an entire year to get between 10 and 30%, which is good if you're dealing with a lot of money. But if you're trying to scale a small amount and make an income off of it, you need to have a tremendous amount of capital. Otherwise, you have to find other opportunities in the market. Now, what happens if we zoom into just this one small area, where now instead of looking at an entire year's worth of movement, we're now looking at individual days worth of movement. So we'll take today, for example. Now, even in a single day, we had this amount of movement to the upside and this amount of movement on the downside. So instead of waiting an entire year, if we were able to enter here and sell somewhere up here and now still risking $100, just with this single move, we would make $341. This would happen in the matter of 1 hour. We can have multiple of these opportunities in a single day, which allows us to go from making, say, $30 in a year to be able to take that same amount of risk and be able to make $600, $700, $800 in a single day, risking $100. Okay, but as the numbers get smaller and we're dealing on a zoomed in 1 day view, the math and the strategy behind this starts to get a lot more complicated, and it gets more important to know how to do this to properly calculate your risk. Not only that, but we need to know where we're buying and selling and the likelihood of that happening. So just as an example, if you're new, you're especially not going to understand exactly how this works, but this is a trade that took about 2 hours where I was basically able to pick an area where I expected for the price to significantly drop, enter in, actually be able to make profit from the market going down, which even a lot of people don't understand that you can do, especially good when markets are moving down to know how to do this skill. And you can see I followed this down for hours, going up $2,400, $2,600, $3,000, nearly $4,000 before taking the trade off for full profit. And that was only risking $500 noticed that I was able to make over $3,000 in about 2 hours. Okay, this isn't to brag, it's just to show you that if we can use this ideology and framework on a daily basis, these are the opportunities that if you lock in and take it seriously, that are going to be on the table for yourself. But before that, let's talk about all the tools in websites that you're going to need to set this up for yourself and start as a beginner. Okay, so realistically, you're going to need 3 major things. First thing is going to be TradingView, which is where we're going to be doing all of our charting and analysis. That's going to be your home base. The second thing that you're going to need is some sort of way to actually place trades. Now, you're going to need some experience before actually doing this. Okay, but considering I trade cryptocurrency, I like to use Blowfin or Bybit. I'll show you how specifically to use those a little bit later into the video. Okay, and if you're looking to trade stocks, a lot of our traders are using topstep.com. The third thing you're going to need is a trade journal, which I'm going to provide to you, but more on that later. Once you make your way into TradingView, you're going to have a screen that looks something like this. What you're going to want to do is click on products here and click on super chart. That's going to bring you to a plain chart like this. Now, when it comes to style and really setting this fully up, I have an amazing video you can go through that I'll bookmark at the end of this video, so you can watch that after and get fully set up. What I like to do when I'm trading is take my TradingView, put it on one side of my screen, and I'll take my trading platform where I can input my orders, and I'll put it on the other side. So now I want to share with you some fundamental trading information so you fully understand the approach you take with trading. So anytime you're placing a trade, you're basically selecting what's called a pair. Now, a pair is going to be any sort of asset that you're either buying or selling against the value of the US dollar. Okay, so this is Solana versus the US dollar, which the US dollar is going to maintain a pretty consistent value, and Solana will either go up or down against that value, which is going to create price movement. The way we manage our pairs is using something called watch list, which is over here on TradingView. Okay, so for example, if you're creating a new watch list, we can click this plus button here. And if we want to go to cryptocurrencies, we can click on Bitcoin, XRP, Sol. We can start selecting different cryptocurrency pairs to have in a list here, which will allow us to flip between and to have access to viewing how these individual charts are moving. So when I'm looking at a chart here, you'll see we started off with a line chart. So it's basically a line showing how the price is moving. And then I can switch between something called candles. So candles are a better way of getting information as a day trader. Okay, so the way candles work, okay, considering this is a green candle, that means that price started here, went as high as this point, as low as this point, and ended up closing right here. And that's why our candle is green. That's the body of the candle. So we had the total movement up and the highs and lows. Same is true for a red candle, only the open happened here. The close was lower than the open, and the highs and lows remain the same, giving us a red body. If we go back over to our chart here, right, I have black and white, so it's a little bit different. Still looking at a similar example. Here we had the candle open, we had the candle close, the highs and the lows, and then say for example, this candle opened here, closed here, and the high and lows were here. Okay, and these candles are going to show us different information depending on the chart frequency that we choose. So for example, we have up in our top menu here, chart frequencies between anywhere from 15 seconds to 1 full week. So you'll notice I have 2 side-by-side charts of Ethereum. On this side, we have 5-minute Ethereum chart, and over here we have a 1-day Ethereum chart. This green box is the same green box on both sides, only this is one candle showing us the open price, the close price, and the highs and lows. And if we notice over here, this is the high, the low, and this was the total movement over the day, but in 5-minute increments opposed to a 1-day increment. And there's different combinations that we can use, but the lower you go down into the time frame, each candle is going to show you, in this case, 5 minutes worth of movement opposed to a whole entire day of movement. Okay, so now let's get into a section talking about trading psychology. This is the most important part that will either make or break any progress that you make throughout this process. Okay, this is what will keep people caught in a cycle of never getting better, or will allow people to sort of skate through trading and get better really, really quickly. Okay, so I've identified 3 major things that you need to retrain your mind around, and I'm going to explain to you exactly how and why this works, so that once you get through this section of the video, you're going to have an aha moment, and it's going to clear you up to be able to proceed and learn and get started with trading the right way. So I've boiled it down to these 3 main points. Okay, and the first thing that you need to retrain your mind out of is that losing is inherently bad. We're human beings, and anytime you lose at something, this is viewed as you're not sufficient, you're not doing a good job, or something needs to be changed to make you be able to perform better. This does not apply to trading, and you really need to understand that, as weird as that concept sounds, and you're going to understand why in a second. The next thing is being wrong is bad. This kind of ties into losing. Being wrong and losing money we view as human beings. There needs to be a corrective action to fix that behavior. In trading, this is not the case at all. You actually need to completely flip this on its head. The third thing is the misconception that making money on a trade makes it a good trade. This is not the case whatsoever. So let's look at this example so you can understand why things thinking losing's bad, being wrong is bad, and why making money, no matter how, is good. Okay, so think of it this way. Anytime we're buying into the market, one of two things is going to happen. It's either going to move up and we're going to make money, or it's going to move down and we're going to lose money. How we actually go about that as traders is what is going to dictate whether we're successful long-term or not. So let's look at it this way. Anytime we're entering the market, we need to, number one, figure out how much we're trying to risk, whether it's a percentage or whether it's a dollar amount. Say we want to risk $100, for example. That means that if we enter right here, we need to make sure that if price moves down to this level, that we're only risking $100. And in doing that, we can ensure that if this moves up 3x more, now we know exactly how much we're expected to win and how much we're expected to lose. So let's take that same exact example. We have our 1 unit of risk, which we know is $100, for 3x positive units of risk if we're right. So let's say, for example, whatever we're buying is valued at $153.52, and we want to risk exactly $100 on this trade. That would mean that we'd pull up our calculator. I'm going to show you a really cool, simple way to do this afterwards, but I want you to understand the math of how we're actually going to be calculating risk, right? If we want to position an entry in the market, we're going to take our entry value at 152, okay, and say our stop loss level, or this level where we're going to get out for a contained loss, is at 150.52. So we're going to subtract by the stop loss value, and that's going to give us 3. Now we're going to take the dollar amount that we want to risk and divide by 3, and that's going to give us 33.33 units to effectively buy in at, to ensure that if this moves against us, we're containing the risk to $100, and we know exactly what to expect if the trade moves in our direction. So anytime we're looking to enter into a trade, we're already positioning ourselves to accept the fact that we can be wrong and we can lose. And in order to actually get into the market and open ourselves up for the potential of making money, we have to accept that we could potentially be wrong. In that sort of same mind process, a lot of people think they need to be right all the time to actually make money in trading, which is 100% not true. So let's take this for an example. Say we take a total of 10 trades. We've contained our risk so that every time we're losing a trade, we're losing -1 unit of risk. So we have 1, 2, 3, 4, 5, 6, 7 losses and 3 wins. But when we're making these wins, we make 5.2 times what we're risking, 2.5 what we're risking, and 3.1 what we're risking, which is going to give us a sum of 10.8. And on the loss side, it's going to give us a sum of -7. We lost 70% of the time, winning 30% of the time, which is going to give us a net total of plus 3.8 risk factors. So once again, we're risking $100, which is going to leave us with a profit of $380, being wrong 70% of the time. If you want a really easy way to do this position sizing automatically on chart, you can click into indicators, you can search up IT position calculator. This is a calculator that we made on the private side of our trading team. I'm giving it to you guys for absolutely free. You can click onto this, and then basically you can click right here at your entry where you want to take profit and where you want to set your risk to. Then you can actually input your dollar amount risk. Say I want to risk $100, hit apply, and that's going to show you the exact quantity that you need to enter in at that exact amount to risk $100 if the price is to move against you. So if we go through our trading thinking that losing is bad and being wrong is bad, we're never going to put ourselves in market situations where we can actually allow ourselves to be right. The losses that you take are simply opportunity costs to be able to get into the market. Understanding that making money does not make a trade good or bad. It's about following the specific process that you know is going to be repeatable while keeping your risk contained. If you're just going into stuff and putting a bunch of money into it and you're not quantifying your risk, you don't know if it's going to work over time or not by studying it, and you make a bunch of money, you're one decision away from losing every single thing, even if on an individual trade you get lucky and end up making a bunch of money. It's about following the process, making sure that you understand that this is the mental psychology in trading math that's going to put you in a position to approach the markets properly. And understanding that trading has nothing to do with being right or wrong. It has everything to do with understanding how much you're making when you're right versus wrong, and the percentage of time that you are right to be able to determine whether you're going to be profitable or not profitable. This is all going to be based around keeping your risk uniform, knowing how much you make when you're right versus when you're wrong, having your average loss and your average win, and the percentage of the times those are happening, to once again be able to look at this table and figure out if you're not profitable or if you're profitable. Okay,